S&P made its first outside lower close of the year. We're going to talk about why. The 10-year and crude oil keep pushing higher. We're going to talk about how one is helping the other. MicroStrategy's implosion and how to spot them. What is the OVA and how to use it to your advantage? Smart money, dumb money and its major shift this year. What Iran's message could mean for the U.S. and oil going forward. Why the Russian-Ukraine war is escalating and why we must pay attention to it. ISM manufacturing at its highest rate in years and why non-farm payrolls was an absolute dumpster fire. We have a lot to go over. Let's get to it. Welcome back, everybody. Well, we have a lot to go over today. We're going to jump right into it. I want to go through the top 5, or what I consider the top 5 in my head anyway. I want to start with the ES, the S&P 500. Obviously, we all saw this little move down, and this was based upon several factors. We went through this on Thursday. My belief on it is it really has to do with the escalation of war, and we're going to obviously get into that and spend some time on that. We're going to have to, and what's going on there on both fronts, and what probably is going to bring this to a head. But as we can see right here, is it a one-day event? And quite frankly, we just don't know. Now, Friday was pretty interesting because you did see some dip buying in some sectors that I didn't expect, and we will review that. There were 5 major things that we do have to go over, and we'll get into that you need to watch this week coming up. But most important for me is just seeing how we're acting at these levels. And every time we break a level, if I get right back over that and it doesn't stay down for 3 to 5 days, it's pretty much a non-event to me. So I use a 12, a 22, and a 55 SMA. You should use what you're comfortable with. And I use open, high, low, close for those that ask. So if we just put the simplest of indicators up for a minute, we just take a look at the 55. It just looks like another, Thursday, Friday nonsense, right? Doesn't really look like a lot. And if you just overlay the 12, and this is really important for people to kind of get, just when you start looking at different time frames, you might start seeing different things. Now, for me, what I note is that is the single furthest break away from the 12 that we have had all year long. And you might say, well, that doesn't mean anything. Maybe it doesn't. But I find it interesting, and therefore it is something that I take note of. So when I see something like that, I'm like, I will look at it and just go, well, that's pretty much the furthest. Now, I always give some grace to the beginning of the year because you have tax implications, meaning you have all those people that made money and then they take their capital gains in the beginning of the year and then they go from there, right? All right. So you can see this little breakdown. And so that's the furthest that we've been off of that level, drop to 22. And we could also argue that that is the furthest that we've ever been off the 22. Does it mean something? We don't know that. But to not take note of something different in the market, you do at your own risk. I'll leave it at that. So you note that. And then this was fascinating too, because we all know that the economic data that came out that we have to go over. And we are seeing a shift in what retail is doing and what institutions are doing. And we're going to have to cover that before we dive into all this data and make some big decisions. I think some big decisions need to be made this week, frankly. But if you're looking at the RTY, we're hanging in there. This is the Russell 2000. We're hanging in there. There's not really a lot of reason to spend time on this. You kind of walk through it and it's just the same soup reheated. Everyone's waiting for the big breakout. And then what do? Nothing, once again. Then you get bad economic data several times on the week. And what does the Russell do? Nothing. Now, let me get rid of my 4,000 lines on the NQ. And then you'll start to see something here, and maybe you're already starting to see it. I think it's obvious, but maybe it's not. You're starting to see this little slope associated with this, aren't you? Now, is it there? Is it formed completely yet? No, it's not. But if we do some simple things like, okay, well, there was a trend line right here, right? And you can see that trend line, and you can see that we broke that trend line. Now, is that the end of the world? Nope, it's not the end of the world. But it's certainly something we have to pay attention to. All right, so now we have this possible rounding. We have this trend line that broke. And what I like to do with trend lines more than anything is I look at them as fans, and I want to look for the next data point. That would really be about here. And you can see we broke that. Now, what is bothersome here about this is the following. And I really don't need a lot of fancy indicators today to point this stuff out. But what's to me is this. You rally back up and you can't break that trend line. Okay, you rally back up and you can't break that trend line. Okay, and again, trend lines are open to interpretation. There's no hard, fast rules where this is how you must view the trend line. But what I'm looking for, and I think what we can all agree on, is there was one movement up since November. And now what are we seeing out of that movement, right? It's not that we're not as smart as we once were, although if you want me to point out the obvious and state this is when everyone's trading started getting a little worse, isn't it? Right around here, March 7th. So is it your trading that's so good, or is it just that the NASDAQ was going up every week, right? So things to think about. So for the past 30 days, you really haven't moved on the NASDAQ if you take a look at it. All right. But you're not really falling out of bed. As a matter of fact, if you were so inclined, you could argue that for this period of time, you really, even from February 9th on, you're really only out of that little box I just drew for about 3-4 days, right? And then you just popped right back in it. So maybe we should be looking at that particular level. That might be something of interest. So what we might want to do this week is just watch this level and just see how we act. Let's pop that in. It would have been way more dramatic if that level actually popped in at the time I clicked on it. So you can see that right there, and you can see how we're acting, right? That might be an area of interest. Yeah, we'll just say 18.8, but 18.08, but we can always just say right around that 18. Let's just see how this goes. I find that interesting that this was resistance and that is support. And everybody knows this already, but you have like 4 stages to the market, right? You have the stage where you're ripping, you have the stage where you're basing, right? And then what you do is people call it 1, 2, 3, 4. I don't really care what you call it. You call it banana for all I care. But then, you know, are you going to get one of these where you go sideways for a while? And then what makes a decision is, are you going to go up or are you going to go down, right? And what you're always trying to do is you're just trying to figure out and use your head and say, okay, which way is this going? Now, one of the things that I use a lot, and I've been showing this a lot lately, and I'm going to show it again because it does change my trading. I'll say that again. This does change my trading. So when I see this start to form, I use it in line form. When I do see that things like this start to happen, and I do see that the Q's SPY, so this is the NASDAQ divided by the SPY, and I look at this on a relative basis. I look at probably 10 of these. I can probably list them in one of the videos. Maybe I'll do it on Monday. But I start to watch this really closely, and I will drop a 55 on this, and I'll just watch that level. Now, what always gets me is this, and you will notice it in your own trading. If you go back here and just look at January 9th, when you broke back, when you closed from 2nd to the 9th, go look at your trading. Go look at how your trading's been since you broke that on March 7th. See, my trading changes when I break on either side of this, right? I'll get tighter on my trades. And I have found that that is something that works for me. There's a couple other things that I can do with this, but I'm not going to change the colors. I'm going to leave them blue for now. But what you're also going to note is just that you see them getting to the same level over and over again. Again, it would have been way more dramatic if that went in when it was supposed to. And again, thank you everyone for commenting on these videos, doing this kind of content. The reason I'm doing this kind of content and getting so specific is because of your comments. When I ask about specificity or how much do you really want me to get into, it's very helpful to me. So please keep the comments coming, and please keep sharing these videos, even like the retweets or just sharing with someone. I guess if there's a water cooler or wherever, you'd be surprised the emails I get and people thanking me for sharing this kind of stuff. So people can actually start to learn what it truly takes to be successful at trading and how much time actually goes into it. So pardon the slurping, but if you take a look at the level right here, pretty obvious, right? Maybe, maybe not. So then you wait and you take a look at the daily and you go, okay, this is the furthest that we've been off the 55 since we got above it. And to me, this is definitely something that is of interest. So it's certainly one of the things I'm going to pay attention to. I'm going to give you one more XLY, XLP. So this is wants divided by needs. And what I'm always looking at with these kinds of things, because this is consumer staple or consumer discretionary staples, right? You need soap. You don't need those fancy new shoes, right? And what I'm always looking for is just data points. And those data points, when we break the 55, if you go look at what happens, it is certainly something to pay attention to. And then the other thing that you can always look at, because it will determine how inflation is going, I take XLK and I look at it divided by XLE. I actually spent way more time on this than I thought I was going to. But this is important because we're going to go right into a couple things here. And before we do that, I want you to get this. So what's going on there? Are they buying tech or are they buying energy? They're buying energy. If you're buying energy versus you're buying tech, why are you doing that? Because inflation's going up. Give me another reason. Everything's tied to energy and oil. 2/3 of GDP is tied to energy and and oil, whether you know that or not. Even when they take out core on the CPI numbers, it doesn't matter. It's irrelevant, right? It's all locked in there. So you always want to look at this stuff, right? And what do you say? Well, when did you have the single greatest drop in the market? Well, back here, this is when we weren't so smart, right? December 21st, all the way down. When did we start getting smart again? All right, you start seeing these turns, right? The undercut, the higher high. And then we started getting smart again, right? Okay. So these are the kinds of things that you want to look at. You might want to watch that a couple of times. But for me, what I think is telling, let's go to the weekly here. And then we're going to jump into this because we do have to spend some time on this because we do have to pay attention to what's going on out there. Now, whether you look at the weekly, the daily, the monthly, and I was just recently talking to someone about this, and they're right. Yields don't do this. They just don't do this if things are good. Like, yields should not be doing this. So why are they doing this? Because inflation isn't dead, and we're going to get into this in some detail. But what we're starting to see, in my opinion, is are we going to get up to this 460? I don't know. I have that marked off on a daily, but let's get rid of these for a second. And understand that, again, that's a 55. You should use what you're comfortable with. But before we get into this, we need to start looking at what are the players doing, right? So what is, in my opinion, I always like looking at smart money, dumb money, but we call it something different. We'll address it in a second. But if we were to look at this and we just go and drop a line. Now, why did it do that day? Well, that's when Powell basically came out and said that they see basically 3 rate cuts in December. That's when we saw this. And then if you mark that bar off right here and we look at that bar, have we ever really come out of that bar? Have we ever made a decision? So people will recognize these as control bars, right? We see a lot of these like we saw at 8:30 on non-farm payrolls the other day. We'll mark those bars off for people so that they can utilize them. But I want people to watch that bar. That bar to me is significant, right? To me, that is a control bar. And now you made a higher high. You made a higher high out of that, right? Up, 1, 2, 3, go, right? Up, down, 1, 2, 3. You got it? So this is becoming an issue. So the way that I always look at it is you go to the next one. This is a Marbuzu Black, but you'd go to the next one, right? That's kind of how I would look. Doesn't matter the vehicle. It's completely irrelevant. But I would look from a technical standpoint of you'd go to this one. And again, we always use the macro, the fundamental, and the technical. But I also think there's things that are keeping yields depressed. And we're going to get to that as well. I think it's fascinating if you watch what's going on right now with smart money, dumb money. So let's get to it. Now, we're starting to see some changes in smart money, dumb money, and we covered this last week that this was coming. And for those that are new, we're just going to review. So we don't refer to this as smart, and we don't refer to this as dumb. Smart money is calculated through investment vehicles that most institutions would use. So we refer to this as institutional money, and that's how you should refer to it as well. That's up to you, but I think it helps. Dumb money is retail. Retail is calculated through ETFs and investment vehicles that only retail would use. So I would refer to this as institutions, and I would refer to this as retail. Now, this is going to do a couple things for us. This is going to allow us to understand when these lines move, and you can just see how the blue is smart money or institutions and red is dumb money. So I thought we'd go over that because we're going to spend some time on this, and we do get some new people below. So when you're over this line, 0.7, that is considered optimistic, very optimistic, and this is considered very pessimistic down here through those lines. And then, of course, you have in the middle. But the devil's in the details like anything else. Once you understand what these are, then you can start going through this and calculating it yourself and find out how you want to use the data versus how they want you to use the data. And to me, that's always been the case. For example, you wouldn't want to sell just because you broke here and retail's too excited, right? Now that we know that this is retail, retail's overly excited. So would we want to get out when this is happening? Well, if we did, we would have missed this move. So that's not optimal. That move started right around there if I look at it. So that's not optimal. Okay, well, if institutions are buying or selling, do we want to get out? And then you can see these moves here. Well, possibly, but then at the same time, we're watching retail come in. So what is the best way to use this? And we're going to describe that right now. For me, the way that I like to use it is I want to look at the differences in opinion. I want to take a look and see who's where and why they are there. And so we're looking at 3 years right here. This is Sentiment Trader. This is not something that I put together. This is by Sentiment Trader, so right down here. So I want to look at this and I see these huge gaps. And then you're going to get a spread between these gaps. And we're going to talk about the spread. We talked about 2 weeks ago. And I covered it early this week because I kind of saw what just happened setting up. So I do want to address this. Now, what we will note is we will note certain changes. Those changes happen when dumb money, or as we refer to it, retail, gets really giddy. And then after they get really giddy, they start realizing maybe I shouldn't have been giddy. Now, there's a period in time in this chart that I'm not saying it to make everybody laugh again, but from here over, it's very difficult to use any of this data between this period of time. And the reason is because the Fed injected $1.7 trillion in the market. So you are completely skewed because not only was retail buying and institutions trying to figure out what the heck was going on. You can see when they finally capitulated and were maxed out at the top, when there was no money left. When the Fed stopped buying, that's when the market stopped. So to use this data, to me, it's really hard to use, right? Because it's very skewed. So we're not going to use it. And we can talk about that later and you can comment below. But what we're going to do is just look at this data because this is the new trajectory without Fed intervention and without zero interest rates. So when we have that, what we can gather from it is relatively simple. Every time that smart money is down here and dumb money is up here, it looks like, well, it looks like we form a top, right? Smart money, dumb money. So is it that simple? Well, it doesn't look that simple because it happened here and we just kept blowing it off. All right, so what was the difference this time? Well, this was the difference between rate cuts and rate hikes. When we said we went from no rate hikes, right, to 7 rate cuts for some godforsaken reason, to 3 rate cuts, to maybe we're going to have to hike again. It was the new talk this week. So what we do know is that nothing has transpired. We do know that despite all this talk, nothing has happened. They just keep talking, right? Once an hour, we have a new Fed member that's out there just, speaking. Now, I think that's important to just note, right? That really nothing's happened except the probabilities and the data's coming out. We can discuss that and get into the macro side of the data. And, we can get into the stools we like to do with the macro, the fundamentals, and the technicals. But understanding this is going to help us get to the next level. So even though we're here, what we're saying is the spread between these two never changes. And this is something that we were talking to for some time. But it's starting to change, and it started to change this week. So this is 3 years of smart money, dumb money. And now we're at a year. Actually, we're at 3. Apologies. The other one was 5. So now we're at 3. Okay. And we're going to drill into a year. Shocker. So here you can see it's starting to get tighter. What do you notice here? You notice the higher high. All right. So we have the higher high on what? On smart money. So institutions are buying more, but look who's selling? Retail. So what's happening? These lines are starting to get closer together for the first time. All right, so now we have 3 years. Again, sentiment traders graph. Let's take a look at this just a little bit closer. So what we can see is from our line right here, and we draw that over just so you can see it. So we have smart money creeping. And if we look at dumb money, we can see that we're below that line just a little bit. This line's a little thick, but I'm not going to change it. So you can see right there where we're at. Okay, and this is the year. All right, great. Now when I do year to date right here, and you can see the date right here from Jan 1 over, what do we get? We get the crack, and we can see right here that best case you're at the same spot, but we can see very clearly here that you're nowhere near the same spot and you're definitely higher. What does this do for us? This lets us know that that spread is changing. So let's go take a look at that spread. And I really want to hammer this point home. The more you know about the indicator or oscillator that you're looking at, the more informed you are, the better decision you could make. Because you could say, well, why is that happening? If you just look at it, RSI or a rate of change or whatever it is, and you don't know why it's doing what it's doing, well, that's an issue. So here we are 3 years out, sentiment trader, and we're crossing that line. So what we want to do is we want to denote things. So this is obviously when the spread is one way, and this is obviously when the spread is another, and then we can see these peaks below right in here. But we're seeing the obvious, and what I think is pretty obvious, but I'm going to point it out. So when the spread is like this, okay, and you're over on the spread, smart money, dumb money, right? And you crack to the downside like here, what happens? Well, you're pretty much putting in a bottom, aren't you? And that bottom is confirmed. And then what starts to happen? The exact opposite. All right. So if we start saying, well, what do you mean the opposite? Well, when we're up here, and we'll use it because this is when the Fed actually did stop putting money in. When you crossed up here, this marked a high. So then if you come here and go, well, this is pretty low. And when we got to that and then reversed, well, that kind of marked a high as well. Here we have a little guy. Well, we're going to mark him off right there. Let's change that color. It makes me uncomfortable. And we'll come here. Oh, now I've got a mixed cross, but we're going to have to deal with that. And we'll go there. And we're going to have to mark that one as well. And then you have another one here. And hopefully you get where I'm going with this. And now where are you? Well, you tried 1, 2, 3, 4 times. If you knock on a door long enough, eventually the door opens, right? And you can see the skew from here to here to here and how that skew's going. I think that this is pretty obvious stuff, but you can see that you're crossing that line for the first time. And to me, that means that we're setting up for something. Now, what are you setting up for? Well, you're setting up, in my opinion, for the same thing that happened the last time it crossed here, here, let's call this one, and here, right? I think that's what you're setting up for. And if you just kind of walk through these, and I'll just mark them off again without anything else on there, and now you're here, and pretend that there's nothing here because there isn't. But if you look at those spots, now that doesn't mean that the sky is falling, but it does mean that you're seeing a shift. And we're all seeing that shift, right? About 2 weeks ago, we talked about this, and we certainly talked about what we're seeing out there in regards to what? Into the corporate buybacks. And we're just not seeing those corporate buybacks because of the blackout period. So that could have some on this too. Now, if we just take a moment to zoom in on this, you get to see it a little clearer. And that's what we want. We want clarity. And you can see how we're popping over. And this number is actually higher than this one. So this is the highest reading we have, and this is up to date. And we'll see what the week brings, because obviously we have a lot of news. But it's very important to understand what smart money and dumb money is doing and the spread, because when the spread kicks either to the downside or kicks to the upside, you get moves in the market. I want to be really clear about this. It does not mean that the sky is falling. It just means that you're struggling. And that struggle could just be something as simplistic as from here over to here until you have the new event, whatever that might be that rallies the market, right? That could be it. And all that is telling you from July to November. And we know what happened into July in 23 anyway. That was when Japan was talking about negative interest rates and getting control of their own economy. And this is when Powell stepped in. So we know what happened, right? So we know the what. Okay, and that's what we always know. Remember when we do the macro, it's the what, the fundamentals is the who, and the technicals the when, right? What, who, when. So we understand this. All right, great. And just to highlight it, you can see what's happening here. And you can see straight across. So this is definitely something that we have to watch and we have to pay attention to because it has forecasted short-term tops in the past, and it is giving us that signal after this week of trading. So hopefully you can see why this is something we have to watch at the same time as yield goes up. And I do think yield's being depressed. We're going to get to that. But I do think as yield is going up, and it's based upon the econ data. And you had a lot of econ data this week that was significant, and we need to address it. Now, to understand how we got here, we're going to have to go through some back data so we can understand exactly what happened here. So ISM manufacturing came out on Monday. When ISM manufacturing on PMI came out, it did something that it normally does not do. And this set us off. So when you look at ISM data and PMI data, and we went through this on Monday, but just real quick refresher. And remember, please subscribe to this channel. All these videos are linked if you're new. They're all linked to one another, and that's so we can just follow through the week. Also, some of these videos that come out, they come out at different times, so you want to click all notifications, especially if I go live. Sometimes it's different times. Notifications will let you know that. Anyway, ISM manufacturing PMI. So there's two kinds of purchasing managers index, PMI. There is manufacturing, and then there is services. Manufacturing is exactly what it says. Services is exactly what it says. We don't really need to spend a lot of time on that. What we do want to spend time on is understanding what the heck's a 50, what's a 47, what's a 48, right? All right, so this is how you need to view this world, the PMI world. If you have a line right here by the Purchasing Managers Index, and you're going to view that is your demarcation line. And what that is telling you is anything over that, anything over this line is expansion. Anything over 50 is expansion, right? Anything up here, once again, is expansion. Anything below is contraction. So anything here is contraction. For point of reference, just for point of reference, and it's not always this simple, but anything under 45 is considered almost recessionary. Anything above 55 is considered, you have a super hot market, all right? Like super hot. Okay, that's what was so concerning about services, but we're not going to spend that much time on it. So 50 is your demarcation line. So whenever you flip 50, people get a little skittish. And what happened was we weren't even close to 50. And we came up with a 50.3. Consensus was 48.4. So it wasn't even like we were expecting it. Matter of fact, consensus was a little higher, but nowhere near here. So let's just talk about this for a minute and look at the absolute difference here and what we got versus what we were expecting. So if we go out there and take a look at this level, well, you go out a year, there's nothing there. As a matter of fact, you actually have to go out much further. So if we take our line and we draw our line straight across, let's draw that straight, and we can see a couple things. All right, so we get a mark right here. Let's put this down so we can just mark it. All right, so we get a mark right here. Now, at the same time, let's just leave this line in for a minute so that we're all on the same page. All right, perfect. And that's on the decline. When was the last time that we had this going up and breaking out on an incline was back here? So when you start to look at it this way, you can see why the market kind of went, and got really skittish and sold off on what normally is a non-event. It's a big deal, and it scared a bunch of people. Now, you take that into Monday, and that moves you into Wednesday. And this was kind of interesting. I'm not even going to go over JOLTS jobs, which was Tuesday, because it was in line. And I know people will be like, well, why didn't you go over the JOLTS number? It was in line for once. Something actually came out the way that they thought it was. Shocker. Services PMI came in light. And this was really interesting because you were getting close to that 55. Remember when we said the heat, bring the heat, right? That 55 level. I'll draw the line, 55 level. And now you're backing off. So that's interesting. And so then when you drill into this data and you came in like that, that's why the market ripped at 10 a.m. on Wednesday. If you go take a look at the market at 10 a.m. on Wednesday, that is why it is so important that you understand the why behind this. Macro, fundamental, technical, the stool. You need to be paying attention to it big time right now. Macro is being affected by geopolitical, and we do need to address that. So we look at this and go, well, that's pretty interesting. And then you just kind of look at where you're at, and that's not really the end of the world. I mean, that's actually going the right way, right? That's going the way that we want it to go, right? I mean, we could actually even say, oh, it's been doing nothing but coming down. And that would be a fair assessment that it's been dropping. And then we get into Friday. At the time of recording this, it's Friday, and we get into no other way to describe it, but this sucks salad. And basically, non-farm payrolls is right here. 303 is where we come in at. Previous was what? 270. Consensus, surely they're going to have this one right. No, no, they do not. 300,000. Now, why was this so dangerous? Why was this so bad? There's a couple reasons why non-farm payrolls today was so bad. And we're going to talk about how it affected the market, how it actually affected the chances and probability of rate cuts. And I think this is a very important distinction. So you have an actual number. And this is all from a site that is called Chartlng Economics. I always try to use free sites so that people can use these sites and they can see what's going on. And then that way they don't have to pay for sites. All right, so let's get into this. So the participation rate's up a little bit, but who cares? Unemployment rate's down. Of course it is. You have 100,000 new jobs. But where we want to look at is go, okay, well, maybe this was all other jobs from other places, right? So then you start diving into it and go, well, was it all government? Like they're padding, so like they're padding the jobs. So the current administration say, look at us. Every administration does it. Look at us. We're giving jobs. And then you find it's corporate jobs. And then you find out it's 63 to 71. You're like, well, that's not really where it came from. Manufacturing. Okay, well, you added 10K there. Non-farm private payroll, 207 versus 232. Okay, 207 versus 232. Consensus was 160, right? So even though here you missed 160 to 232. That's a blowout. It's an absolute blowout. And that's why we were where we were today. That's why the market was weak. Now, you sold off so much previously that this is why I think you got somewhat of a reprieve. But I do think that you have to look at a couple things. I do think you need to look at the fact that 295 or this 300 number, that's a big number. And if you come across, you haven't been here for some time. As a matter of fact, it's been a while. And all this data had a big effect on the market. And just to hammer this point home, if we look at this online chart and you're coming across, this is where you're at. And what's important about this, what's really important about this data, and it looks like I drew that kind of crazy. But what's important about this data is the following. This hit on the upswing coming down. This is still going up, same as the PMI of manufacturing. And that's the problem. Now, this is where it gets interesting. So this site is CME Group, Markets, Interest Rate, Fed Watch Tool. I actually even have it starred. And the reason that I'm showing you is this. When you want to drill into this economic data, you can do this for free. And you can see, hey, did any of this actually affect the market? Was any of this really something that we had to pay attention to? Or are we just looking at stuff that has no, what's the right word to say? No viability. And the answer is this definitely has viability. And let's talk about that viability. So what we're going to see is the following. This is going to show you the probability of a May rate cut or hike. And what is the current target is right here. This is going to tell you 93.3. This is going to tell you 6.7, excuse me. And what is that telling you? Well, there's a 6.7% chance May 1st of a rate cut. And so you'd go here and say, okay, and there is 0% chance of 2 rate cuts. So here's where you're at currently, right? All right, get it? Got it? Good. Now, what we can do is we can look at the percentage probabilities and ascertain what the heck's going on. So if we go out to March 5th, we can see there was a 19% chance of a rate cut May 1st. By this week, the 28th, where are we? 9.3. So we got cut in half. Okay. And then you go to April and you're at 11%. And as of April 5th today, there is a 6.7% chance of a cut. So at the beginning, you can see where we were, where we went to, and where we are now. And I think that's very important to understand. And when you start going through this and looking at June, you're going to see some changes. July's changes to me were to me, I won't say bothersome, but I think that you have to look at them. So you go out to June, and here you are at the current, and we can see that you were at, and we're just going to do the week, 39.6, and now there's a 50% chance. So there was a 39% chance rates stayed where they were a week ago. We're looking at what? 50% chance they stay where they are. Now there was yesterday a 59.1% chance of a rate cut. Today there's a 46% chance. Okay, the probability of a rate cut is getting pushed out further and further and further. And this is becoming an issue. This is an issue. I can't stress this enough that this is becoming an issue. So if we look at this for July, and we're looking and going, okay, current, you get it. They always have the current right here. Again, here it is, free site. If we start looking at this and going, all right, well, now they're saying that there is the same chance that there's a rate cut by then in July. Okay, but look at the probability of 2 rate cuts. And I thought this was very telling. So if we go back a month, you're going to see that there was a 40% chance of 2 rate cuts by this time. Now that's cut in half in 30 days. And now you're down to 20%. Okay? This is getting to the point where it's starting to just push out, and you're hearing the chatter. And now you know why you're hearing that chatter of, even one of the gentlemen today said the next might even be a rate hike. It's not probable, but it might be. I don't think they're going there until they see something like really dangerous. But we are at a spot here where they have a real problem on their hands. And it just might mean higher for longer. And we're starting to see that reflective. Now, what could actually be helping yields? And that's a funny statement that is helping yields. But take a look at this. So why is crude oil and why are bonds acting the way they are? In other words, why is crude oil going up? And then, of course, we're seeing the bond yields go up. But it's interesting. Would the bond yields be going up even more if we didn't have a flight to safety? Now, we saw this on Thursday, where we actually saw bond yields rally. And there was a reason for that. But I think we need to just address a couple of the issues that are going on. First off, the SPR, we know it's low, and we know that they said they're going to stop buying oil. But Europe and the U.S. need each other. It's an interesting statement. We already have NATO, right? So why would you be saying this now? Europe and the U.S. need each other. They are stronger together. SG says, speaking of ceremony, 75th Alliance. Okay, well, that might be why. I don't believe America alone, and I don't believe in Europe alone. I believe in America and Europe together and NATO because we are stronger and safer together. Russia downs dozens of drones as Kremlin warns NATO over Ukraine. Kremlin says Russia-NATO relations have slipped to the level of direct confrontation. Interesting time to give that speech, right? This is April 5th as of today. So what we're starting to see is we're starting to see an escalation into April into these wars. And the question is, why would we see an escalation now? Why would these escalate at this particular time? And why that's of interest is because from a trading perspective, how long could this go on for and how long could this be an issue for is what we're trying to figure out. It's not political. It's more trying to figure out what the heck is going on and why is this escalating. And what we're seeing here is Russia basically coming out and saying, we know what you're doing, and you're putting a direct confrontation in front of us. Russia has downed 53 Ukrainian drones, the majority of which targeted the southern Rostov region, Ministry of Defense said, and the Kremlin warned that Russia and NATO are now in direct confrontation over Ukraine. The ministry said terrorist attacks with aerial drones overnight and on Friday morning were foiled. 44 of them were downed or intercepted. We have an election coming in November, and what are they doing? NATO plans a $100 billion Trump-proof fund for Ukraine. Proposed 5-year military aid package would shield Kiev from the winds of political change. Okay, so what does this mean? It means that they find some funding, they fund NATO, that money gets marked. So if Trump comes in office, they can't do anything about it, or he can't do anything about it to affect those funds. Okay? Trump will not give a penny to Ukraine, Hungary PM Orban. And this was about 3-4 weeks ago when this came out. All right. All this stuff is coming to a head. Again, it's not political, but now you're starting to see why this is escalating. And then we actually can see this being escalated into oil volatility, which we're going to get to in a second here. We're going to bring this home. But you need to understand why this is happening. Remember, we're going through the stool today. We're going through it pretty hard where you're looking at it from the what, the who, and the when, right? The macro is the what. This is the what, okay? The who is the oil. When, we're going to get to that. But you got to connect all the dots right now, and you have to look at where this is going. Do you think that this is going to get less accelerated going into November or more? Because I think it's going to be more accelerated with both fronts. Trump urges Netanyahu to get it over with. Questions Israel's approach to the war in Gaza. I mean, he could be a little more diplomatic. I'll just leave it at that. I'm not going to get political, but maybe a little bit more. So again, we already know his stance on this, right? We can already see where this is heading. Okay. Republican presidential nominee has recently found himself increasingly at odds with GOP wavering loyalty to Israel. Okay. 2 senior military officials have been sacked after 7 aid workers were killed in a missile strike in the Gaza Strip. Okay. Escalation, escalation, escalation. Gaza was having problems. There was a lot of issues there with humanitarian aid. Couldn't get in. Now the humanitarian aid has stopped and they can't secure the safety of these people. So they fired a couple people. All right. So this happens and all heck breaks loose over there. At the same time this is going on, we're running into other issues. U.S. is on alert for possible Iranian attacks on Israel and American facilities officials. Iran vowed revenge this week, causing Israel in the death of a top Republican Guard official in an airstrike in an embassy in Syria. So we're seeing things here, updated 8:05 p.m. this evening. So what are we seeing? Vowing revenge, Iran plans homage to IRGC generals killed in strike. Thousands of people gathered in Tehran on Friday in the funerals of 7 members of the Revolutionary Guard killed in a strike in Syria that are Iran blamed on Israel. The guards, including 2 generals, were killed Monday with the airstrike leaving Iranian embassies annex in Damascus. Okay, this is what's happening right now. Everything is getting escalated. And my personal opinion is not that one side is doing the escalation. I want to be very clear about this. That's not what I'm saying. I think both sides understand that if they're going to have the situation they currently have, which both sides understand, meaning Russia understands their situation, Ukraine understands their situation. If there is any change in any administration, right, what do you have? You're going to have more uncertainty, right? Do you want to have the new devil or the devil you know? Right? You always go to the devil you know, right? That's why they always want the incumbent, right? They always do, just the way that it is. So this is a huge issue. And now we're finally seeing it reflective in oil volatility. Take a look at this. Now, in front of us is the OVX. And you're going to say, well, what is the OVX? What is the crude oil volatility index? SIBO crude oil volatility index. SIBO crude oil, this is directly from their site. Volatility index is an estimate of the expected 30-day volatility, just like the VIX, as priced by the U.S. Oil Fund, USO. Like the SIBO VIX, OVX is calculated interpolating between 2 weighted sums, option mid-quote values, in this case, options on the USO ETF. 2 sums essentially represent variances, blah, 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 blah. 30-day period, same as the VIX. Got it? Good. Came directly from the site. Okay. So now you know what you're looking at, and you can go to the SIBO if you want to understand more. But it's always important for us to understand what we're looking at. Just like about a year ago, I was trying to explain to everybody to start looking at MOVE. Remember this. You might remember, it might not. And this obviously is the bond option volatility index, right? So you all remember that one. Or if you're new, now you know 2 things. So if we take crude oil, we're going to notice something really neat here. So we take crude oil and we overlay crude oil with this. And what we're going to note is if we zoom out on this and we just do the simplest of things and just drop vertical lines. So we spike and then you'll start to see a move higher. And then you spike and then you see a move higher. Every spike, even if there's a drop in crude, which is in orange, what we'll note is that even when we see these spikes, there's always a follow through. Here's your spike. We never got the follow through. And now what we're getting is this again. So where am I going with this? It is not realistic to assume that these spikes that have led every time to higher oil prices are not going to lead to higher oil prices now. It's not realistic to assume that. With 2 wars going on right now, it's not realistic to assume that. And this is what was really bothersome. I'm going to show you this, and then I'm going to tie it to a trade so that you can learn how to use this stuff yourself. Here's what was really bothersome to me. So you always, when you look at crude oil, right, or you look at any asset class, and we're going to go into this in detail, but when we look at any asset class like crude oil, what bothered me the most on Thursday was this. Here's crude oil, and then if I take energy and I take even the exploration, and I overlay this, and I do this literally all the time. Like this, I do this trade a lot. So you're going to want to pay attention to this. And I'm going to give you a live example of this. So here's the 4th, and let's go to that 930 level. And I appreciate you dealing with the fact that these are not edited. It just saves me so much time to not edit them and just rock and roll with them. Here's what we're going to look at. We're going to go here. We're going to drop this down at 930. And this should always concern you, always. And this was my concern for Friday morning. This is why I was better safe than sorry. This is how I always look at it, right? Always reduce risk. When in doubt, get out. Oil, spike. Look what energy and XOP did. Look how they fell apart, okay? Whenever you see this on an asset class and you have a divergence like this, whether it's a short-term or long-term divergence, you always pay attention to it. The underlying stocks that are affected and trade the asset class should always be moving in tandem with it. The best trades are when the oil is moving up, for example, slowly, and the underlying asset class is moving up fast. And I can give you several more examples of this. But we use this strategy a lot for a trade. Take a look at this. Now, I'm going to walk you through a MicroStrategies trade, but I want you to understand how we find these or how we know to be looking in this space. And I think that this is really important. Move this out of the way. So one of the things for me is I look for divergences of any kind. I find divergences extremely helpful. So if you have something like a MicroStrategies, your divergence is going to be when it's doing the opposite of Bitcoin. And this could be with any hard asset. So I will refer to Bitcoin as a hard asset and these names as hard assets. So for example, if you have FCX, right, which we know is a copper name, and if we just drop this into a line form for a second, and let's clean all this stuff off, I'm gonna just make this a bear chart, all right? And then you just take copper, for example, and you drop copper in here, right? And then you're going to get the differentiation. And they're pretty much trading in tandem, right? So when you hit a 5-minute bar, they should trade in tandem. If they're not trading in tandem, something's wrong. Meaning as the underlying asset goes up, then this will go up as well. So like if I type in gold for a second and we watch gold, now let's just get rid of copper and we're going to use something like Newmont, right? They should be trading in tandem. They don't have to be exact, but if gold's going up, Newmont should be going up. If it's not, you can just see the little mark from here, then there's a problem. So this is a great example because the other day when crude moved, and we'll clean off Newmont now, but when crude started moving and you start looking at XLE and XOP, this was where my concern was actually Thursday. And right or wrong, when it happens, you want to honor this because when it does go, it can get super, super ugly. And so I always pay attention to it. But for example, here is crude, and then you can see how crude is following the energy names, right? Now, if I go and I go back and I take a look at this, and that's the 5th. But let's go to the 4th for a second so I can show you a divergence here. Because that's really what you're looking for, right? So let's go to this, and this is what scared me. Well, scared me. I'll use the word scared. So you see when crude popped up and you see how energy and XOP went down? That's what you need to pay attention to. This type of stuff, like that, when you saw that huge market sell-off on Thursday, when you see divergences like this is just Amityville horror. The market's just saying, get out, right? That's exactly what's happening there, okay? Really important concept. All right. So when you see Bitcoin doing something like this, and we're watching Bitcoin, let's clean off these energy names. And again, we're just not going to edit this. And I appreciate your comments just saying, just keep with the content. Don't worry about the editing because it helps me get way more of this stuff out. But if you're looking at something like, right, and we're going to mark it from that date on, and then you go and drop MicroStrategies, which was the trade, well, you're going to notice a huge difference from that zero line, right? And obviously, Bitcoin trades a little further at the time of recording this than MicroStrategies, but you're seeing a massive divergence there, aren't you? And you can start seeing that divergence start kicking in more and more. Now, it wasn't just Bitcoin, or it just wasn't MicroStrategies, but you saw it with coin too. So this is telling you that even though the underlying asset is up, that the names are going down. So this presents an opportunity to look for shorts. This is what you're looking for. So that presents the opportunity. The underlying asset really is the fundamental driver, right? So that tells you what, right? Remember how we have the stool, and the stool will tell us who, what, when. This tells you that, right? It doesn't tell you when. So you get the who and the what, but you're not getting the when. The technicals will tell you when. So let's get to that. So the when, what we're going to get from the when is we're going to get the ability to enter, or we're going to find the ability to enter, right? So we can see this neckline pretty clear right here. And then the question becomes, towards the end of the day, am I going to be able to buy puts? Not only that, but am I going to be able to get this trade off in this period of time, right? Because by the time we did this trade at the end of the day, we were running out of steam. And you can just see this demarcation line. I'm just going to draw it straight across. So you can see this demarcation line and actually see how far it goes. And then I'm going to drop this to an hourly so you can see how we're looking for where to actually exit the trade. So that's what I have. Now, the question that you're going to ask is, well, how do you know? How do you know it's going to drop? You don't. You're making a bet. What I will do with these situations is I will use rate of change. Now, rate of change, you can look up what it is. For time's sake, we're not going to get into all of it, and I use just standard metrics here. I don't use anything too fancy. But what you'll note about rate of change, see these lower highs? And you see how you had lower highs here? So it's flying, but that's not really the issue. The issue is the zero line. If you have negative rate of change, that means you're going down. You can't have negative rate of change and have the stock go up. It doesn't work that way, right? So as you're breaking down and you're making lower lows and you're staying below the zero line, it's becoming increasingly clear that this has the potential to fall off a cliff. So you don't know that it's going to happen. Let's be real clear about that, right? No one really knows what's going to happen. And so what you're doing is you're setting up your levels and you're looking for, okay, well, where could this break to? And where I came out was, I'm like, okay, well, here's really that neckline. It was like 1463 is what we came up with, right? Because you broke out, bonked, and then you ran. Okay, now here's the trade and the alerts that we put in so you can see it live and see the timestamps. And I'll walk you through my trade so that you can actually see what I did. Because you're running out of time at the end of the day, right? So it's a speculative play. There's no stop. You're in it and it is what it is. And you have this position and you know that the spread on these options is insane. We're going to talk about how to get out of that as well. So I'm going to stop break even means BE, break even. It's just shorthand. And so what I'm doing is I'm trimming into the strength, right? But this is how we're getting out. You can see when I got out of the rest of them. And I didn't have that many on at that point, right? I was out of a lot of it. And it was only like this trade was only like a 1% trade, but it worked out. And this is us just, what we're doing here is we're setting the target, right? So I'm putting this out there and there's the timestamp so you can see it. And we're saying that 450, 460 level. So what we're doing is we're getting out as the getting's good. So in front of you is the trade. Now, this is really important to get. In this account, this is an aggressive account. You guys have seen me show this account before. I'm risking literally 1% of this account to do this trade, right? That's what I'm risking. So my investment at the time was like 4,500, something like that, right? 4,650 it looks like by the time I got in, all right? So you're seeing that right there, and that green's the buy. What you have to do with these trades is as it's breaking down, you have to get out. And people will talk about the spread. So listen to this part of it. You need to make sure that if the bid and the ask, let's say that the bid and the ask is like 8 by 12 or whatever insane it is, right? You have to think about why he's doing that. One, he's not your friend, and you know the option market maker's not your friend. But what you want to do here is you want to get out, but in the right way. So you want to go out there and put your offers out past the ask. And I know that sounds counterintuitive, like, well, why wouldn't you put them on the ask? Because what you're doing is you're making him reach. And so when this panics and it breaks to the downside, your ask is already out there. So he's going to take it, right? He's not going to wait. Okay? He's just going to grab it because he needs it. So when he starts looking for it and it starts free falling, he's just in as much of risk as somebody else because he could be out of position with his delta, right? So you want to have something out there for him to grab. And that's what I was doing. So like here I'm selling 3. So I'm selling the third, we're up in here, and then boom, all of a sudden I have a double. I'm selling 3. It breaks down again, I'm selling more. So by this point, right, I'm out of half that trade. So no matter what happens with it at this point, I'm up. I'm up to break even, right? I made a little money. Breaks down again. Where am I getting out? Right into that. I'm getting out. I have my offer out there so that he grabs it. And then I'm just leaving the rest on and letting it play out. And then at the end of the day, right, it worked. Okay. So obviously I'm going to get out of it. I have to, because you don't want to go home long or short it if they want to sign it or however your account's set up. So this is how you would do it, but you want to make sure that you're getting out of it while it's going on. You don't want to be getting out when it rallies. You're not going to get filled properly. You'll get filled, but you're not going to like it. So I hope you found this helpful. Comment if you want to see more of these. Now, at the beginning of this video, I said that we were going to cover 5 topics, and we've covered 3 major topics so far. You can see meta breaking out here, and I'm just going to point out the obvious. We can all see what's going on here, right? I mean, that is a clear, utter breakout out of a flag, right? There's not really much more to say there, is there? So I just want to point out and be Captain Obvious for a second. But the important thing is that you understand that there is way more going on under the hood besides what's going on in meta. So you have other names in this sector that are just rocking and rolling, okay? And we're trying to figure out why. But as we're trying to figure out why, you're seeing the XLC start to lead. And we're starting to see the XLC lead over the SOX. Now, can the XLC lead? Can these names lead? Yeah, they can. They're big enough names that they can lead. So we are going to watch the XLC names versus the XLK names because we can see that they're getting a little tired, a little long in the tooth, and nobody really wants that Apple headset, right? We can all convince ourselves that they really do, but quite frankly, at the end of the day, Apple's got a lot of problems here. So we are seeing a change between XLC and XLK, aren't we? Right? And so what we can always do is we can always just look at these on a relative basis. And what are we seeing? We're seeing a massive change. That is one concept you need to remember as you go into this week and something that you want to pay attention to. Number 2, we went through this 3 weeks ago. We've been talking about these banks since they have a new president. We were talking about these banks. If you're in the community, you already know this. We started buying this one at $4.50, $5. You're back to $9. Your next level that you're going to want to watch on these, you're going to really want to watch and see if you're just going to completely gap fill. You should completely gap fill because it's getting better and better there, right? They're at a surplus. Argentina is at a surplus now. And there's no reason that these are not heading back to those levels. And again, if you're in the community, you already know this, and we already have positions in these and have been playing positions in these for a very long time. GAL is heading back to this level. Again, you can see this no further, but looking at what's going on with Argentina here, let me clean that off. We're up, I think, 10% in this already. We've been playing it forever, but you're seeing another breakout right here. So what you want to see here, in my opinion, is just follow through. So this is definitely 2 topics that you want to pay attention to. Now, the third, this Wednesday, you're going to have CPI. And you're going to have to pay real close attention to this. Last CPI came out and beat. You could see this 0.4. You see consensus did not move up. So we beat last time, which we don't want to beat because that means rates are going higher and inflation's here to stay. Consensus is 3.7, right? Forecast. So they're trying to say this is an anomaly. 0.4 inflation. So you have core, which is X food and energy, right? And you're starting to see, well, this is the previous number, and consensus on year to year is that we're going to go higher. Higher is not better. Higher for longer is not better. And there is less chance of rate cuts as that comes out. This will be watched very, very closely. That's it.